All right, so we got a lot to get through and we got less time than usual to do it. So I'm gonna dispense with too much. I do want to talk about what's going on with the weather because I can't figure it out. It was like in the teens on Monday and now it's 70 degrees outside today. I'm gonna blame Dr. Caden for that one. All right, let's go ahead and get started. Which of the following internal controls is most likely to justify a reduction of control risk regarding or concerning plant and equipment acquisitions? Now, this one's a little bit of a questionable wording because these are not all internal controls. So that was kind of an identification. We need to identify something that basically was a control for this to be appropriate. That being said, it's a little bit more transparent if we think about it that way. So let's go ahead and I'm going to look at A, and then I do want to look at the rest of these, okay? A says periodic physical inspection and reconciliation of plant and equipment to detailed accounting records by internal audit staff. Now, if we're talking about a control, does this sound like an appropriate control for this situation? Yes, okay, and that seems like the most intuitive answer for this particular situation. The problem is that we can't just leave it at that. Even though that sounds reasonable, we want to look at the other answers. So let's look at the other answers and eliminate those as well. Comparison of current year plant and equipment account balances with the prior year actual balances. Now, is that a control? Actually sounds like an analytical procedure to me. So that's why I wouldn't select that one. Review of pre-numbered purchase orders to check unrecorded trade-ins. Does that sound like a control? Having pre-numbered purchase orders would be a control, but the review would be a test of the controls. So this is kind of a delineation between what's control and a test of control. So C would be excluded for that reason. Approval of periodic depreciation entries by a supervisor independent of the accounting department. Now, this is a control, okay? Approval would be a control, but we're talking about approval of depreciation entries. Would approval of depreciation have anything to do with the acquisition process? Probably not, okay? So we can actually identify each of the reasons that each of the other three answers are not correct, and we can eliminate those. Now, I would not ask you a question this vague on the exam, but I do think this is a good exercise and activity to get in the habit of working through to make sure not only do we understand why is the correct answer, but why are the wrong answers not the correct answer. And we've taken just the entire semester to get to that point. Yeah, hey, but it's good news. So you can use that for the upcoming exam. So property acquisitions that are misclassified as maintenance expense, most likely to be detected by an internal control system that provides for what? So let's go ahead and think about this before we answer the question. What would be the accounting effect of this particular transaction? So we're talking about they're misclassified as maintenance expense. What would be misstated? We'd have probably an understatement of property, plant, and equipment and an overstatement of maintenance expense. So let's go ahead and look through the answers. Investigation of variances within a formal budgeting system. Now, again, is this something we've specifically talked about? Probably not. You've talked about this in other classes. This sounds like a Dr. Otero thing. All right. Would this be a good identifier? Would this be a good control for this particular problem? I kind of like this one. That's the whole purpose of variance, is to identify where there's basically larger discrepancies than we should identify. So let's put a pin in that one. That's a possibility. Let's look at the rest. Review and approval of monthly depreciation entry by the plant supervisor. Now, this is a good control, but does this control relate to the valuation within those particular two accounts? Probably not. Okay, I don't think that's appropriate. Segregation duties, employees in the accounts payable department. Now, this is not a segregation of duties issue. This is a misrecording issue. This is where something should have been recorded as one item, but it was recorded as another item. Segregation of duties would not solve that problem. So it's not C. Examination by the internal auditor of vendor invoices, a canceled check for property acquisitions. What would this test? This is obviously an audit test, but what would this cover? This would cover making sure that the assets actually exist. Okay, making sure the assets actually exist. We're not worried about that. We're trying to make sure that there was a proper classification of expenses in the right counts. So this was a really difficult question, but again, I kind of gave this to you to make you think about this, about what would be the most appropriate point. And so A is the answer on that one. I promise the last one will be a little bit more straightforward. Okay. Which of the following combination, okay, that's right. Which of the following combinations of procedures would the auditor be most likely to perform to obtain evidence about fixed asset additions? Now, let's go ahead and go back to what I've been talking about during all these process areas, okay? If I'm talking about assets or revenues, what is usually my primary assertion in this area? Assets and revenues is going to be existence occurrence, okay? Now, just for context, if I'm talking about liabilities, equity, or expenses, my primary assertion is going to be completeness, yes. Just remember, keep that in mind. Do we have a test for fixed assets that tests expenses, that tests at a really high level of reliability? Yeah, inspection of fixed or inspection of tangible assets. Remember, we talked about this. We could use it for multiple tangible assets, but it's commonly used for large assets like fixed assets. We can also kind of use this in investments, which we'll talk about in a little bit. But inspection of the actual tangible assets. If you see a building, that's a lot of assurance saying, well, there's a building. Yeah, it does exist. If you go to the place where the building is built and you see a patch of ground, it says, I'm suspicious about the existence of this building. So that's going to be kind of our standpoint. Now let's use that to move through the answers, all right? Inspecting documents and physically examining assets. Well, physical examination assets and the underlying documentation is probably good evidence about the existence of the asset. So A is probably our answer, but let's go through the rest. Recomputing calculations and obtaining written management representations. That's more BAA, which I don't think would be irrelevant, but I just don't think it's the most likely that an auditor would perform about fixed asset additions, okay? Observing operating activities, comparing balances to prior period balances. In what way, shape, or form does this have any test work related to fixed asset additions? None really whatsoever, okay? So C is right out. Confirming ownership and corroborating transactions to the inquiries of entity personnel. I really just offended by them saying that corroborating transactions through inquiry, because we already know that inquiry has to be corroborated. So it'd be like corroborating and then corroborating again. So that D is personally offensive to me. It's personally offensive to me. So A is our answer right there for the logic that we talked about before. All right, 15. Auditor's primary purpose in examining a letter received from the bank shortly after the balance sheet date that renews and extends an entity's note payable is likely to obtain evidence concerning management's assertions about what? All right. So we're going to ignore the answers for the time being because these answers are outrageous. But I do want to think about this. So renewing and extending a note payable. What do we know about notes payable when they come due? So they're traditionally classified as what category of liabilities? Long-term, okay, long-term liabilities. When they are due, in the period they were due, they get reclassified as what? Current assets. This is saying, look, we're not collecting the note payable just yet. We're going to extend it, and it's going to be paid at some point in the future. So that means that it should still be properly classified as a long-term payable. So this is clarification about what the classification of this particular item is. So I want you to think about that and think, I'm looking for the answer that best aligns with classification. The problem is that the editors in the book still just don't know the difference between a lot of assertions. They just throw a whole bunch of them out there. So we've got presentation, cutoff, and disclosure classification, which are not combinations of assertions, but the word that classification is the one that's right there. Is presentation still relevant? Yes, this would need to be presented in the financial statements. Okay. Is cutoff also relevant? Yes, simply because we want to make sure that we have the proper recognition for the time period. Okay. When the what the classification should be during that particular time period. The most relevant piece of information is the word classification. So again, this is not a great answer. This is one of those interesting backpedals. So remember, I've been talking this semester about how they've improved some of the answers in the book, how the editors have been doing a better job. This is one that's newer to not to this edition, but actually the previous edition, where they had a much clearer answer and they added additional language to make this less clear. Okay, it's still the correct answer. If I were to ask you this on the exam, I would be focused entirely on the classification mechanism. All right, so 1519. Although the quantity and content, oh, sorry, that's not it. An auditor compares the current year revenues and expenses with those of the prior year and investigates all changes exceeding 5%. By performing this procedure, the auditor would be most likely to learn that what? Now, here's what I'm going to do for this one. I'm going to do something kind of unsavory, okay? I'm going to eliminate C and D because I don't want to deal with them, okay? I'm just going to say the answer is A or B. And I'm going to assume that most of you kind of looked at A or B and said, this has got to be the answer. So let's look at A. Prior year, sorry, not fourth quarter, I'm getting really confused today. Fourth quarter payroll taxes in the current year were not paid, all right? So that seems like a really appealing answer. So what happens if fourth quarter payroll taxes are not paid? Does that affect the payable that's recognized? To some degree, yes, because it will eliminate the payable if it's not paid, but the payable still exists. The recognition of the expense transaction still takes place. Because remember, a lot of times there's separation between when the expense gets recognized and when the payment takes place. So you record a salary expense and you record the payable, and then you reverse the payable when it gets paid and you recognize that. So the expense itself is still going to be in place regardless of whether the salary gets paid, which is basically saying that that's not going to affect the revenues and expense categories. The payable, yes. Sellers, revenue, expense, no. So A looks like an appealing answer, but if we think about it, it's not a correct answer, okay? What about if the entity changes capitalization policy for small tools in the current year? What does capitalization mean again? means that if Barnes was lowercase B-A-R-N-E-S, that we do an uppercase B-A-R. That's capitalization, right? It's what you learned back in elementary school. What does capitalization mean, guys? Come on, you got to know this. So basically, we recognize an expense as a cost of the asset as opposed to expensing immediately. So remember, you learned about expenses back in 220, and then 221, you said, okay, instead, we're going to make this a cost of the inventory. That's capitalization. You can do that with any asset. What happens if we turn something that should be an expense into a capitalized item? Well, the expense in the current period goes down. Would that affect the expense amounts in the current period? Yes. So that's why B is our correct answer. All right. That one is a tough one, by the way. That's why we spent some time talking about it. All of these questions are pretty tough right now, but this is the natural extension of where we get to the end of the semester. The good news is I've got some easy questions for you coming up. Whether or not you found them easy when you did them, that's the big question, but let's go ahead and take a look. So we've got a bank transfer schedule, and I want you to look up here, date dispersed per, and we got one bank over here where the disbursements are taking place and deposits are when the deposits are taking place. Now let's just think about this logically, okay? And I want you to step back to the 1980s, 1990s. Take a walk back in time with me, because I know you all are just kind of like credit card payment, Dr. Barnes. That's what I do, or Venmo, something like that, because you're hip. Someday I'm going to feel like I'm up to times in Venmo, and they say Venmo is so outdated. It's now some other tool, Dr. Barnes, and I'm going to have to download another dang app. Okay, quit changing on me so quickly. But anyway, what is the terminology we use for a bank disbursement? What is a easy way we can term that? Not a Venmo transaction, not a credit card transaction. What is the old school term for that? A check, okay? So we can think of these as checks, and then deposits are just deposits, all right? Deposits are just deposits. So then if we think about that from that perspective, the tick mark diamond most likely indicates the amount was agreed to what? Well, we said these are checks, so we probably want to look at the outstanding checklist of the applicable bank reconciliation because we know that those are checks. Same logic holds here. We're just looking at the tick mark triangle. It's saying which was them agreed to. We're looking at the deposits of the in transit of the applicable bank reconciliation because we're looking at a list of checks and a list of deposits, and we want to compare those to what our internal lists are. That's all you really need to do to answer that. Again, these are problem-solving, critical thinking questions. I selected some really, really challenging ones for this activity, but if you think about it from the proper perspective, it makes a lot more sense. All right, this one, hopefully you didn't struggle too much on this one. If you did, well, that's something we need to work on. So the primary evidence regarding the year-end bank balance is documented in the one. So let's go ahead and let's talk a little bit about bank reconciliations. So we as auditors have a responsibility to test the bank reconciliation. Does everybody agree with that? Okay, because we talked about that on Wednesday, how we actually test the bank reconciliation. We need 3 items to test the bank reconciliation. What is the very first, most obvious item we need to test the bank reconciliation? The bank reconciliation. We need the bank reconciliation because we want to know what it is that we're trying to prove. We're trying to prove that book balance. Now, the book balance is simply a function of the bank balance, which is at the top, and everything in the middle, all right? Now, everything in the middle will eventually be captured over time, and we're going to capture that in the cutoff bank statement. But this question is saying the bank balance, which is basically what we're starting with and trying to get to the endpoint, how do we determine if the bank balance is correct? What do we want to do for that one? What do we call that? The standard bank confirmation. That's our second document, and the cutoff bank statement's our third document. So if we want to validate the beginning bank balance, we want to check the standard bank confirmations and the accompanying reconciliation. Okay, so that's how we approach that particular question. I actually think that the accompanying reconciliation, this is a new wording as well. I think that's a little bit misleading. The most important part is this right here, standard bank confirmation. All right, question 1619. An auditor testing long-term investments would ordinarily use substantive analytical procedures to ascertain the reasonableness of the what. Now, here's an interesting throwback, all right? Before we even look at this question, I want you all to think about this because this is a list of assertions listed up here. Which assertions can analytical procedures test? Does anybody remember that back from chapter 5? You had to learn that from chapter 5, and it's like just out of my mind, Dr. Barnes. I don't even remember what analytical procedures are, but no, analytical procedures can test primary assertions. And I told you 90% of the time they test one assertion, but 10% of the time they test another, but you need to know both. So what's the assertion it tests most of the time? Give you hints, begins with the letter V. VAA, it's the only one that begins with the letter V, okay? The other 10% of the time it tests one that begins with the letter C. What was that one called? Completeness, okay? All other assertions are not testable via analytical procedures. If you remember that, 2 of the answers are just gone, okay? Existence and classification, tossed them out. Okay, we can't test those using analytical procedures. The question then is, which one is it? And then default is going to be, or say, valuation, Dr. Barnes, because you said 90% of the time. Now, let me give you a piece of life advice, okay? 90% is not 100%, okay? The sooner you learn that, the happier you'll be in life, okay? If you think that something is a sure bet, it's 90% certain, that means that one time out of 10, you're going to be very disappointed, okay? All right, so you got to know that expected value, the odds of this. Valuation of marketable equity securities. Do we as auditors care what the market value of equity securities are for our financial statement analysis? No, we do not. We don't care. I almost said something very vulgar. We don't really care. Okay. We don't. Anyway, so we don't have any concern about what the valuation of is in the external market. We're only concerned about what's in the books. So this one we can eliminate just because we don't care. But what about completeness of recorded investment income? Is that something we could test via analytical procedure? Yes, and we want to make sure that that's fully recorded properly. Yeah. Okay. So even though VAA is our primary test for analytical procedures, this is one of those ones that logically completeness is the correct answer, just for the reasons we talked about. All right. To establish the existence and rights, they're basically the same thing in the context of investments, and a long-term investment in the common stock of a wholly traded company, an auditor ordinarily performs a security count or what? Now, we talked about this. Let's think about the existence aspect, because we didn't specifically talk about rights and obligations, but for all intents and purposes, rights and obligations and existence can be bundled together in this particular concept. So if we're testing existence for investment, our primary test would be a physical examination or a security count, looking at the securities themselves and saying, yeah, I can validate that this is what's recorded. This is what's actually written on paper. This seems like a valid security. That would be our strongest test. Can we always do that? No, okay, because it's not all the securities themselves are not always held by the party, the client that we're auditing. They're not held by the first party. Sometimes they'll be in the hands of another party. So what is our primary test whenever we want to reach out to another party that's not us or not our client? It's third party request. What do we call that? Confirmation. So confirmation is going to be our best test, but there's a problem. We have two answers that are confirmation, okay? So the question is we're trying to determine existence of rights and obligations. So let's look at the answers. Confirms the number of shares owned that are held by an independent custodian. Confirms the number of shares owned with the issuing company. Okay. Now of this, both of these answers are potentially correct, but we're looking for the most reasonable correct answer. Who is going to have the most up-to-date information? The issuing company or the current custodian? The current custodian, they'll have the current most information. Now, I'm not saying that this is a completely and totally illegitimate answer, especially if it's a recent issuance. This might be a good source of information. But if we're talking about what would be the better answer of the two, we'd probably be talking about the current custodian, the one that's currently holding the securities as opposed to the one that held them at one point in time. So B is our answer here. All right. Now I'm going to apologize for this next one because this next one is ridiculous. I think it's the best question I could suss out, but it is kind of silly. So we have 7 audit procedures here, which if you go through these audit procedures, some of these procedures test multiple assertions and they're a little bit messy as far as their approach, but we only have 3 assertions. So let's start with the assertions and let's talk about these from an intuitive perspective, how we would approach them, okay? I think this is the more valuable way to approach this particular question. And if I ask you a question like this on the exam, I'm not going to give you 7 options and then 3 tests, especially when some of the options are just ridiculous, okay? So let's go ahead and work this. So our assertion is rights and obligations, and we want to verify the entity has legal right to the property equipment acquired during the year. Now, let's just think about this logically. Let's think about this from a non-audit perspective, all right? We want to determine that you own your car. What is the easiest way to prove that you own your car? So, for some reason, I am saying, do you own your car? Andrew, do you own your car? So yes, I own my car, Dr. Barnes. Says, don't shake your head. So, yes, okay, yeah. So you're going to prove to me you own your car. What is the best way for you to show that? Show me the title. Okay. Say, look, this has my name on it. Okay. It's my car. Okay. You can prove it. Even if it's not my car, it's my car. Yeah. So yeah, that would be the way to approach it. So we're looking for something that's going to be a form of documentation that shows ownership. So let's go ahead and look back at the answers. Do we have anything that kind of consistent with that? What about examined deeds and title insurance certificates? That show rights and obligations? Yes. Okay. So that's our answer for A. All right, verify that recorded property and equipment represent assets that actually exist at the balance sheet date. This is a throwback to what we just talked about. What is our strongest test for property, plant, and equipment that we can perform, especially if we're trying to test existence. Inspection of tangible assets, okay? Again, look at the building. Yeah, building exists. How about that? Okay. All right. It's either a very complex hologram or it's an actual building, okay? And the way you can determine it's not age, you can go up and throw your hand through it. It's like, oh, bang, hit the wall. Yeah. I'm sorry. Anyway. So we want to actually examine or do a test of the actual proper we want to inspect physically examine the item. So inspection of tangible assets. So physically examine all major property and equipment additions. That's an easy way to determine existence for it. Verify that net property equipment are properly valued at the balance sheet date. Now, this is an interesting one because there's a three-letter word here that give us a lot of clues, but we have to think about this really closely. This is not saying verify that property and equipment are properly valued. This said net property and equipment are valued. Now, what do they mean by net? If you look into a series of financial statements, they may say net property, plant, and equipment. What is it net of? It's the actual, the historical cost of the property, plant, and equipment, net of depreciation. Yeah, net of depreciation, which means that probably the biggest foundation or the biggest hurdle that we're going to go over is going to be determining if depreciation is treated properly. So we have to think about that. If we're talking about net property, plant, equipment, what is our concern with respect to VAA? It's not the historical cost. We know the historical cost is correct because we probably audited that in a previous period. What's going to be needed to be updated is the current period depreciation, as we know that's correct. So let's go ahead and look at what we got. So it says to two, review the provision for depreciation expense to determine that depreciable lives and methods used in the current year are consistent with those used in a prior year. It's the only one I think we've used depreciation, and that seems the most consistent with our explanation for C. So C is 2. All right. Now, this one's a little bit more straightforward. This one was more of a refresher because I wanted to make sure that everybody could remember how to do an analytical procedure in this type of area. So the Brant Group reported total interest expense for the year of $2,000. And then we've got the monthly balance of their long-term debt, interest paid monthly on the average daily balance during the month, the annual interest rate for the debt is 6%. So remember, we did this back in chapter 5, and it was a pretty easy process. We take the average monthly balance, we multiply it times the average monthly interest percentage, and we come up with that expectation. So let's just do that. Did anybody go through and come up with the average on this? So we add them all together, it's 915,000. We divide that by 12, that comes up to $76,250. Okay. So that's basically our average monthly balance in the account. Now, what's our next step? To multiply that times the average interest percentage, which we don't have to really second guess this one. It says the annual interest rate is 6%. So 76,250 times 6% is, assuming everybody did this, so I'm asking you all to give me a number. If you don't know the number, make one up. $1 billion. Not $1 billion. What's that? So it's basically around 5,000. It's actually $4,575. Okay, $4,575. And if you did not get that number, go back to chapter 5 and rewatch that lecture. Okay, it's like Dr. Barnes, we passed that exam. No, we're not. Everything is relevant still. Everything is relevant still. This is proof of that. All right. So $4,575. Once we get to that point, what do we need to do? We need to compare that number to the recorded amount. Is 4575 close enough to 2,000? Obviously, no, but how do we validate that? Remember, we had to have some sort of basis for determination. What was that called back in analytical procedures? Well, you're on the right track. It's tolerable something, but it's not tolerable misstatement. Tolerable difference, tolerable difference. How do we calculate tolerable difference? What was our rule of thumb for that? No, that's materiality. So tolerable difference said 5 times the recorded, sorry, 5% of the recorded amount, not 5 times, 5% of the recorded amount. So what's 5% of $2,000? It's $100. So we have to be within $100 of $2,000. Is 4575 within $100 of $2,000? It is not. Now you may be able to look at this and say, yeah, this expectation is too far off, Dr. Barnes. We would not accept this. If I ask this question on the exam, which it's possible I may ask a derivative of this question on the exam, you would have to tell me specifically the tolerable difference is it's greater than the tolerable difference that what we could expect. So we have to be within 1900 to 2100 range, and we're way outside of that at 4575. So that would be the explanation you'd have to provide for something like that. All right. We're moving really quickly. Wow. Going great. One advantage of talking fast. Fung CPA has been engaged to audit the financial statements of Vernon Distributors Incorporated. Oops, it's getting cut off because of the way they present this stuff. Hold on. This is one of my problems with this presentation system is that, yeah, some of this stuff you can't actually see if you don't have it. So let's see if I can get it on here. Nope, I can't even fit it on the page. Goodness gracious. I hate McGraw-Hill. All right. All right, let me just read it off of what I got here. So Fung CPA has engaged to audit the financial statements of Vernon Distributors Incorporated, a continuing audit client for the year September 30th. After obtaining an understanding of Vernon's internal control system, Fung set the internal control risk at the maximum level for all financial statements and concerning investments. So what is the highest level of control risk we have? Maximum level, what does that mean? It means maximum level. We just crank up the thermostat and just try to bake in the room. What is that? What is that control risk level? What would we say? We have 3 control risk levels. We've only talked about 3. And they have very definitive alliterative terms, okay? Not alliterative. High. Yeah, that's all I'm looking for. I'm looking for high control risk, okay? So control risk is high. Fung determined that Vernon is unable to exercise significant influence over any investee and none are related parties. Okay, so we don't have any issues with that. That's good to know. So they determined to run a detailed analysis of the investments in domestic securities. So showing this information down here. So let's go ahead and look at this in detail. And this is really, really annoying because this is related to a completely different problem right here. So another presentation issue. So then with all that information presented here, then it's going to be listing out the partial audit program and substantive audit procedures. Now, I think this is an interesting exercise and we can go a lot more detail, but one of the most important things here is being able to identify these activities, what assertions do they relate to? Because these are all viable activities we have related to the investment process. So we're going to go and we're start at number 4. We're going to go through each of these. Attain positive confirmation of the investments held by any independent custodian as of the balance sheet date. Okay. Now, if I ask you to test all of the assertions, what are the possible list of assertions? There's multiples of them, okay? But let's go ahead and let's assume that we want to focus on one primary assertion, then we'll talk about the rest. What would be our primary assertion that we would want to test using confirmations if we're talking about investments? Investments are what type of account? They're assets, okay? What is our rule for assets? Primary assertion is existence occurrence, okay? So existence occurrence would be our primary assertion. Now, that being said, can we test other assertions using this? Yes, we can test completeness, valuation, allocation, accuracy, and to some extent some other assertions, but our primary assertion would be existence occurrence. And if I ask you this question on the exam, that would be a likelihood of a concerned about is what is our primary assertion that I'm trying to test using this method? So talking about confirmation. Determine that income for investments has been properly recorded and accrued as collected, referenced by published sources, by computation, and by tracing to receivables. All right, so tracing to recorded amounts, not to receivables, tracing to recorded amounts. Now, this is an interesting one because we see properly recorded and we tend to want to go in one direction because that's basically saying we want to make sure it's recorded for the correct amount. If it said recorded to the correct amount, what would be implied there? Which assertion? That'd be VAA, okay? But it says properly recorded and doesn't have any reference to amounts, all right? And then it uses the word tracing. So that word tracing has been a kind of a catchword for us this entire semester. So if we're talking about tracing to the recorded amounts, first of all, is that being used correctly? Are we going from source to record? Yes, okay. So we are tracing. So we're talking about which assertion? Completeness. Now, make a quick note of this. This should be pretty obvious right now. I do want to make note of this that, again, I'm not going to try to fool you. If you see the word tracing on the exam, you should think completeness, which is probably a big clue that I will not directly use the word tracing or vouching on the exam if I want you to test this. I want you to be able to know the direction, which is why I've been trying to get you to understand that when you see tracing or vouching, you still need to think about whether it's proper direction. Every single example we've looked at recently has been the proper direction. That does not mean that I will tell you that on the exam. I'm not going to use the words tracing or vouching if I talk about this. So you do need to get into the habit of thinking about the direction. All right. Investments in non-public entities. Compare carrying value to information in the most recently held audited financial statements. All right. So this one's a pretty interesting one. This one, so for reference, we're talking about 2 source documents that we're agreeing the information across source documents. So what did we talk about with respect to that on Wednesday? When we're agreeing source documents to one another, we're just checking amounts to make sure they're consistent with one another. What does that sound most like to you all? VAA, that's going to be a VAA test. All right, determine the transfers among held to maturity, trading, and available for sale securities have been properly authorized and recorded. By the way, the solution to this one's funny because it basically says multiple assertions again. But if I ask you this question in the exam, I'd be concerned about one primary assertion and then maybe some secondary assertions, because presentation and disclosure would be relevant here, or presentation, I should say, not presentation, disclosure. Presentation would be relevant here because we would need to make sure that this is disclosed in the financial statements. But primary to that is going to be the fact that we have three different account types that securities could be categorized in. All right. There's the word. All right. I almost said it, by the way. What does that mean if we're talking about the categorization of particular accounts? Classification. Okay. And that's what you should have been focused on. Now, are there other assertions that could be tested as a part of this as well? Yes. But again, we're thinking about primary assertions. This one's going to be classification. By the way, don't get thrown off by the word authorized. I'm not going to ask you a question on the exam that's going to say which assertion and then authorized is going to be authorization will be a correct answer. In fact, if that happens, I will guarantee not only will you get credit for that question, but I will give back to everybody extra points if I ask you a question where authorization is the correct assertion. Okay. There may be a question where authorization is the correct answer, but it would only be in context to segregation of duties. Hello. This is our visitor. We're almost done. We're wrapping up some homework stuff. So. All right, and you can criticize me if I say anything completely and totally inconsistent here. All right, last question here for this: determine that any other temporary decline in the price of an investment has been properly recorded. Okay, so here's an interesting one. We talked about proper recording in a previous situation, and we said it doesn't have to do with the amount that's being recorded. So what assertion did we say was relevant in that situation? So going back, we're talking about 5. We're talking about proper recording. That was completeness, right? We have another proper recording item, but this one actually has to do with the whether it was properly recorded at the correct amount. Does that make a difference? Yes, it does, because now we're talking about which assertion? VAA. We're talking about the valuation allocation accuracy assertions. Yes. So it's important to note that we have to distinguish those. We have 3 possible assertions with respect to recording. If we see recorded, full stop, we're thinking completeness. If we see recorded at the correct amount, we're thinking VAA. What if I say recorded in the proper period? Which one would that be? Cut off. Yes, very good. All right, let's go ahead and do our bank testing. Was anybody intimidated by opening this file and saying, oh my gosh, this is going to take forever? Yes, yeah, it did. Did it take you forever, Michael? No, okay, not that long. You did a lot of shortcutting, right? All right. So basically filling it out, make sure that you fill out the items here. So I'm not going to fill out, and I'm not going to go through each of these, but I do want to talk about some points that we need to clarify. So filling out this first work paper, did anybody have any items that jumped out where they had to say there were errors or concerns? First of all, did everybody put their initials down? First of all, that's what I'm looking at. I'm not having you submit that part of the assignment, but I want to make sure everybody put their initials down. So then we had items. Where did the error concern come up? Number 5. Okay. So let's go ahead and make sure we note that we've got an error concern, but we'll talk about where that comes up. Okay. So moving on to here. So we've got some items that we need to put notation on. What is this notation called? What do we refer to that as earlier on when we talked about documentation back in chapter 5? What is that called? Tick marks. Okay. Yeah. Remember there are 3 elements that are part of all documentation. We've got the header. Okay. We've got the tick marks, and then we've got the indexing and cross-referencing. Now, I want to remember that because we're going to talk a little bit about cross-referencing here in just a second, because there's a what did I say about cross-referencing? If it's always important, make sure that we have clear, clean, consistent documentation. So this is going to be a good example of that. All right, so then we have our tick marks that are coming in, and we have the balance per bank statement. So remember, we're doing a bank reconciliation testing. We start with a balance for a bank statement, and then we try to determine all of the adjustments that are in the middle to verify that our book balance is correct. So if our balance for a bank statement needs to be correct to start with, where do we go to find that information? What is that particular piece of information called? Standard bank confirmation. So we'd want to put that. Fortunately, this is in 16.3, which got the standard bank confirmation, okay? But you'll notice that one of our tick marks down here actually says trace to the bank confirmation, trace balance to the bank confirmation, which actually refers to work paper 16.3. So we can put that up here. I believe that was a C that comes into the tick mark up here. It actually says tick mark here. I thought you guys were so intelligent for putting tick mark, but it actually has a comment in there. I'm less impressed by your intelligence now. Still extremely impressed, but less so. Yeah. Yes. All right. And then we got some items here that are going to be listed here. We got our deposits in transit. What is the document that we would check that against? The cutoff bank statement. Yes, remember the cutoff bank statement, and actually says trace the amount to the cutoff bank statement. Yeah, remember I had a little bit of umbrage with word tracing, but ignoring that, then we can go ahead and just move forward with that. So that's the diamond. I believe there's another one down here that we also have to do for adjustments, making sure that NSF check gets recorded properly. All right, so better bank reconciliation, but that wasn't enough. It would have been enough if we were just doing the bank reconciliation test, but we're going to do some additional tests as well. So now we have our standard bank confirmation. And let's go ahead and put the drop down. It says we're going to basically tie this back to one of our documents. Which one are we tying this back to? Which reference, work paper reference? 16.2, okay? So this is saying, this is where you can find this information. It's 16.2 and 16.2 saying C, which if we look at C, it's saying you can find this information at 3. What is that called? It's a cross-reference. Remember we talked about the idea of a cross-reference? Pieces of information that are going to be used across working papers need to refer back to one another. This is a really important tool so that our partners can know what's going on whenever the working papers are prepared. Is that a consistent statement? Brixton? All right. All right. So, and then we're moving on to our general cash account. Okay. So in this particular situation, let's look at our tick marks and make sure we have this. We're going to vouch the amount to the bank reconciliation. Now, is vouching used correctly in this particular terminology? So if we assume the bank reconciliation is an earlier source document, then we're moving downward to an earlier source document. So it's a little bit suspect. It's not as clear vouching, but I would still say that the vouching could be appropriate in this situation. That implies that we're testing existence occurrence, which may or may not be the case, but we can go ahead and work with this, with what we've got. So let's go ahead and put in our triangles. So the Greek symbol for this is delta, right? Yeah. I was never in a Greek system, so I can't remember all the Greek letters, but yeah. All right, and then we got this December bank charge. Did anybody note a problem with this bank charge? It doesn't what? It doesn't exist, which may be actually pretty big credence to the fact that we're testing existence here. So what do we need to do here? If this is the case, we need to actually put in this. There's an error that we don't have this bank charge listed here anywhere. So that's going to be correct. Now, the reason I say that it doesn't exist is that it does exist. It was just not apparently recorded in the reconciliation, which kind of throws wind to the idea of existence occurrence, which again, it's the terminology. It'll be a little bit clearer on the exam, but again, this is basically the type of assertion that we're looking at here is not as relevant. What's relevant is trying to identify where the error is. So that's where the error came up. And we say that that's consistent with the error that we identified here, part 5. That all the items were included on the cutoff bank statement, that we could not find this item in the cutoff bank statement going back to our reconciliation. It's not in the reconciliation anywhere, so that's consistent. All right, just for context, let's go ahead and look at our last few work papers. Okay, so I want to take a really quick look at the legend and the tick marks to make sure that we're consistent here. Now, we said this letter F is footed and cross-footed. So what does footing mean again? Yeah, adding, so footing implies I always mess up vertical and horizontal. Vertical addition, cross-footing is horizontal addition, or it shouldn't say addition, computation. That's a better appropriate term. So what are we going to be using in each of those situations? We're going to use in the F, and then we're going to be matching this information to subsequent documentation. So let's go ahead and fill in our NSF check and our bank charges, which we can say that we trace this back to the cutoff bank statement. Everybody good with that? All right, and then we're going to be matching this information here to subsequent documentation. So I don't even know what the symbol is. It looks like the letter Y. What is that one, guys? The Y. Okay, we're just getting Y. Yeah, okay. I would have stood there for several minutes before anybody spoke up. Okay, yeah. And the letter U, which, yeah, okay. So Y and U, because I'm operating in this language. But what's that? That's mu? Well, it sounds like you. All right. So agree to the cash receipts journal and agree to the cash disbursements journal, which should, interestingly enough, are going to be our next journal items. And we would actually use the same notation to cross-reference this back. So put in the delta here. And then finally, put in the delta over here. All right. So then your final wrap up. This will not work for me. There we go. Oh, there we evaluation. There we go. This. So your final evaluation was to be looking at each of these work paper tabs that you wanted to look at and see if there were any issues. Now, what would we say would be the primary assertion that we'd be concerned with here? Doing the bank reconciliation, we saw a lot of terminology and tracing and vouching. So we might think completeness and existence occurrence, but remember I said we don't necessarily want to hang on those as terminology for assertions. So what would we think our primary assertion would be in this area? So we're talking about items being recorded at the proper amount, which would imply VAA. Okay, so we want to make sure that we test on the VAA. Are there any other possible assertions we could test as part of this? So I would argue that probably existence, occurrence, and completeness would be tested incidentally. And then what about cutoff? Do we think that cutoff could also be a part of this? We're talking about a period of time looking at transactions that occur before and after period end. So we would actually have some ancillary test on cutoff anymore. Cutoff in there. So the assertions that we list up here, primarily VAA with some testing in other areas, depending on what the nature of the tests were. And that kind of does it. So congratulations on finishing the homework for the semester. Yeah, isn't that great? No more homework, just exams left, So much better. All right. So we have one of the members of our advisory board here, Matt Maynor. Matt is a partner with KPMG and he served for the advisory board for several years now. It's 2019. And yeah, so he's done with his talking to the advisory board, and I thought it might be kind of fun for him to come down and share some wisdom with you all about what the careers look like in auditing right now. This is something I talked to Dr. Caden about. I have not been in practice since 2010. So he's definitely got a much better insight as to what the real world looks like. So if you really have questions about what the modern auditing and accounting firm looks like, then this is a good opportunity to listen to what he has to say. So if you'd like to come on up and share some wisdom with us, we would certainly appreciate it.
Hi, I'm Matt Maynor. Nice to meet you all. Do you just want a question and answer session? Do you want me to cover something? I'm happy to do whatever you'd like.
Maybe just kind of like a little bit of a spiel about how auditing is kind of transforming currently, and then maybe a few minutes at the end for some questions.
Okay. So I was here, actually taught in this room as a grad student teacher, accounting 211 back in the day for 3 semesters. Back in 04, when I taught, I graduated undergrad in 03. So I am at KPMG in St. Louis, audit partner, been there for 21 years. Entire career in St. Louis. I have done a rotation in the national office for the last 2 in New York City, and I came back to St. Louis on 10/1 of this year. So what I would say is all of those things are factually accurate from what you're doing. You will see work papers similar to that. I will tell you the big 4 accounting firms, we are all on a standardization push. So what I mean by that is you are still working in Excel, you are still working in Word documents, but they're all templates that have been built out by the firm. And so what the goal is that you go from any client, any city in the US, and in the bank rec, the reconciliation, CAS confirmations, it's all going to look identical. So you can literally plop from one engagement to the next engagement, and there's no tailoring it of how each engagement team wants it or how every partner likes to see something or little fancy tick marks. It's all been standardized. The other fun fact is those activities that you're doing at that level, while those are all going to be necessary, none of you will actually do those things as an associate, because we send everything over to what we call the GDC, which is Global Delivery Center, which sits in India. And every lowest level procedure, the associates send them over, they go over at night, they come back in the morning, and you guys review and check it and sign off as review, opposed to actually preparing something like that. Then we move you up, you do the preparing at the more difficult level. So it's actually kind of an interesting thing. Those activities I would have been doing in paper when I started, and I would have been doing those. Now, I would say our associates would rarely even touch that. You send it over with standardized instructions. You send over and you don't even actually send the information. It all sits on a shared drive that's been locked down. And you may ask, how does that work? To transmit information across the world to a different foreign country, it actually does not go and leave the US. They actually port back in to a server that sits in Montvale, New Jersey, and all the information actually sits in Montvale, New Jersey, and our global delivery center Mumbai, India actually ports back in to there. And it all sits there. We create a PVC tool. Every client, we create access to it. And clients then literally you name it off, you drop them in and they drop off, they check it off. Everybody gets emails, including the client and the staff, that says X PVC number has been delivered. It's sitting out there. And then you literally just type that in your instructions and they can go look. There's literally no emailing of anything anymore because it just sits on a shared drive that is all linked up. So that's a little fun fact there. What else? Whatever questions do you guys have?
So I'm sure you get this question a lot, and this is something that we haven't talked about directly, but how is AI influencing how things are going in auditing right now?
So AI is effectively driving. So what I would say is one of the largest challenges most people have is figuring out information. There is so many accounting standards, so much information out there, guidance from the firms, guidance from various industries, that what it does is basically goes and pulls the data. So actually a couple of the new AI tools that we've rolled out in the last 6 months, it will actually pull it. You click open a link at the bottom and it actually then tells you and provides a link back to, and you can run this 2 ways. You can run it off the web or you can run it off of the firm's internal systems and information. And so if you run it off the internal system, it'll actually provide you the link to the source document in which it's pulling from. So you can actually go validate if it's actually right. It's still creating, I'll say, some pollution activities. It's not always correct. The biggest issue now is not that it's not correct. It may be pulling aged guidance in you. And that's where being able to see what the guidance is it's referencing, I can quickly see, okay, you're pulling something around how we test information from 2016. I know that's dated and we've superseded that guidance. And you'll tell us, you literally then retype a prompt. I need something pulled from X year. In my case, I know it was after 2020. I don't remember the exact year. You tell it, it'll actually then go find it, pull the new source and update the flow. So it actually does heavily increase the efficiency of all parties, just because, especially I'll say at the associate and senior level, it allows you more easily to actually go find an answer and then bring it to the manager, bring it to the senior, depending on what level you're at, and be like, okay, this is what I think we need to do. This is based on what I find. And so it really does speed up the process, opposed to you just sometimes having in the past sit there, wait for someone to get out of the meeting to be like, where do I even look for this? Other than trying to Google something and, finding some random information that was not correct. So.
Any questions from you?
I have a tax internship this summer, and I'm just wondering, so I got that like, year and a half ago, how it can look going between tax and audit, making the transition from tax to audit.
What size firm?
It's Andrews and St. Louis.
Okay.
So
I would say that would be very easy.
Yeah.
Again, I don't, can't say for them specifically. Your medium-sized firms, they are going to be less siloed. And so a lot, even if you're an audit in those small firms, you're going to get pulled into doing tax returns and doing tax work in the spring. And so those things are probably going to be very flexible, is my guess. Again, can't speak for them. I will say the larger accounting firms, it is very much you're filling X spots. So the tax people are trying to fill theirs. And there's just so much specialized knowledge that you really don't move. So when I was here, actually, my emphasis was in tax. I took all the grad tax classes. I already had accepted an accounting or auditing internship, auditing full-time position. I took tax classes really for no reason whatsoever, other than the fact of it did help me in the auditing relation of the taxes that were going in under ASC 740 and helping to understand just terminology and how to use it and talk to our tax people. So in that case, it helped me from that standpoint. Did I actually use any of the estate planning and that? No, of course not, right. But it's also just learning how to be able to communicate and I'll say shift knowledge bases. That's what you're really learning. Good question. Do we have a time limit?
So we're going to release class. So I'm going to go ahead and I'm going to shut off the recording and let you all go. But if you'd like to stick around and ask some questions from Matt, it's a good opportunity to not only get some knowledge, but develop your professional networks. And we'll stick around here for a few minutes. And we'll have our exam review on Monday. So please make sure you finish the practice exam and review the study guide then.